Let's get into your pick, Quanta Services. It's an infrastructure play for power. Why is this the right pick for right now in Q2?
I see this as a huge demand that only limited companies can fill, and Quanta is uniquely positioned to be able to help with our grid, expanding our power needs, because it's not just, we've been in this period of time where power growth in the US hasn't necessarily happened. We've been kind of the same consumption year over year. With all these data centers and AI coming on board, suddenly power growth and the energy needs of this country are growing. First off, they're 85% in the US, very US focused infrastructure play. Secondly, our grid has been needing updates, regardless of the extra power needs. We've needed to upgrade our grid. So they do things like grid hardening. And what is that? That's like replacing wooden poles with metal and steel, adding concrete, adding more shields, making sure we're better prepared for natural disasters. Secondly, they've got a little bit of a renewable exposure as well as one of their other segments. And that's a continued play we see expanding again here in 2024. Just a really, really well-positioned company. And again, a very unique skill set that is hard for others to come in and a very, very strong moat around their business.
Okay, you're saying it's a strong moat around the business, and it's kind of like a tangential AI play. I do have to point out, stocks have had a big run up so far year to date. They've doubled the S&P in Q1, up more than 20%. Also, I want to point to something. Their guidance for this year. So their guidance is overall revenue growth of 6.5%, electric power revenue growth, which you're really referencing, of about 8% at the midpoint of the guide. Isn't that a bit muted, considering how much you're saying that they're going to see a benefit from AI? In fact, Jeffrey's out with a note over the weekend saying, basically, when's all this AI hype going to turn into revenue reality? Why aren't we seeing more, at least projected growth from them, if they're such an AI beneficiary?
I think they gave themselves an easy hurdle to beat, which is always nice. And I think that midpoint guidance by the halfway point in the year may end up getting raised because they do have a huge opportunity set. Their major customers include people like Duke Energy, PG&E. All of these areas are putting a lot of money. Their backlog is huge in that sector. And so I think it's an easy hurdle for them to potentially beat and raise down the road a little bit. But they're also, remember, a long cycle. You don't just say, hey, I need you to build this power line or fix this power line or install new lines or work on moving things underground. Those tend to be long lead projects, so their backlog is huge. So yes, I do see them growing. Actually, they're projecting free cash flow to grow 25% this year. It's a little bit counter-cyclical of when they get paid on contracts. Okay. So I think they're very, very well positioned. All
right, so this company actually also technically a REIT, and for a REIT, the dividend's actually very low. The dividend's only 0.14%. Also want to point out, I know you don't always focus so much on valuation, but it is trading at 31 times forward earnings. Aren't you paying up a lot for a REIT with a very low dividend? And also you're saying they're trying to play it safe. They want to beat their guide, but the growth that they're projecting is pretty muted as well.
It is, and because these have been transforming very quickly, and companies don't always issue guidance on what happened in the last 90 days. Sometimes these are very deep set. So I look at this and say the power opportunity in the United States has grown tremendously over the last 6 months. So they may be being a little bit slow on, okay, what is a real growth opportunity for us? What are we going to communicate to our shareholders versus what we potentially see as catalysts internally? And I think companies do a very good job of setting that expectation. They may see more catalysts than they're willing to publicly disclose, because once you put that mark out there, if something were to happen, then obviously that's the mark that investors hold you to. So I see this as a very conservative guide. Obviously, the winds of change are moving quickly in the United States, especially for these power needs and grid needs, as well as you have to realize, the Inflation Reduction Act, all of this infrastructure spending. I see them again as a huge net beneficiary, and not one, again, that you have a lot of competition. So no, they're not a dividend play. No, they're not a traditional REIT, but the growth story is very well intact for them.
All right, we got to hit on your dark horse pick as well, Devon Energy. Why is this one the dark horse?
I see them as under the radar. They had a really bad, uncharacteristic 2023. They lagged their peers almost 25%. They've been struggling a little bit with execution, which again is extremely uncharacteristic for this company. I see them returning to form. They have some great exposure direct to WTI. We're seeing WTI rise, from the 70s to mid 80s. At 85 WTI, Devon's got a 13% free cash flow yield. They're planning on giving 70% of their free cash flow back to their shareholders, either through share buybacks or variable dividends. And so the one thing is, number one, I do see their execution improving. Number two, CapEx is supposed to fall about 10% this year. That'll help that free cash flow. Their debt is in really great shape. I mean, they barely have any debt on the books, but they're going to continue to make their balance sheet even better. I look at this as a dark horse of coming off of a bad year. Okay. I think Devon could really benefit.